Before we dive in, a quick but important disclaimer. I am not a licensed financial advisor, and this presentation is for educational and informational purposes only. The information provided in this video is not intended as legal, financial, or tax advice. Please consult with a qualified professional before making any financial decisions. Your specific situation is unique, and the details of your policy, or any policy you consider, will vary. Imagine this for a second. A man, will call him David, pays faithfully into his life insurance policy for 25 years. He does everything right, never misses a payment. He tucks the policy away in a filing cabinet, confident he's secured his family's future. When he passes away unexpectedly, his wife, overwhelmed with grief, finds the folder. She files the claim, expecting the financial lifeline they had planned for. A few weeks later, a letter arrives. It's not a check. It's a denial. Buried in the cold, corporate language is a reference to a single exclusion clause on page 19 of the 40-page document. A clause about a pre-existing condition that was disclosed, but not in the exact way the insurance company's underwriting required. The safety net he spent a quarter of a century building vanished because of a sentence he never understood. This isn't a scare tactic. This is a reality for thousands of American families every year. And it's the reason we're here today. Because life insurance is one of the most important financial tools you will ever own, and it is by far one of the most misunderstood. It's an industry built on complex jargon, confusing options, and a sense of uncomfortable urgency. You're forced to confront your own mortality while trying to decipher terms like cash value, riders, contestability periods, and universal versus whole life. It's overwhelming by design. It makes you feel like you have to just trust the person selling it to you, sign on the dotted line, and hope for the best. Well, that ends today. Right here. This isn't just another video explaining life insurance. This is your decoder ring. This is your guide to pulling that policy out of the filing cabinet, or confidently shopping for a new one, and understanding it line by line. My promise to you is this. By the end of this series, you will be able to look at any life insurance illustration and know exactly what you're looking at. You will understand the critical differences between the types of policies and, more importantly, you will know which one is actually right for your specific situation, not the one that pays the highest commission. You will learn the questions to ask that agents hope you don't. We are going to transform that feeling of confusion and anxiety into one of clarity and total confidence. You won't just have a policy, you will master it. And understanding this in 2026 is more critical than ever. The financial landscape is shifting. New hybrid policies are entering the market, combining life insurance with long-term care benefits. Interest rates are changing how permanent policies build value. The way we work, live, and plan for the future has been fundamentally altered, and your life insurance strategy needs to reflect this new reality. What worked for your parents might be a terrible choice for you. The old buy it and forget it mentality is a recipe for disaster. Let's start by immediately torpedoing the biggest myth that stops people from even getting started. The idea that life insurance is outrageously expensive. The media loves to talk about million-dollar policies with $1,000 monthly premiums. But the reality for most people is completely different. A recent study showed that more than half of all Americans overestimate the cost of term life insurance by more than 3 times. They think a healthy 30-year-old is paying hundreds of dollars a month for a significant policy. The actual cost? For a 20-year, $250,000 term policy for that same healthy 30-year-old? It can be as low as $15 to $20 a month. That's it. That's less than a few cups of coffee at Starbucks. It's less than a Netflix subscription. The perception of high cost is the industry's best-kept secret, because it either scares people away entirely or it funnels them toward more complex, expensive products they may not need. So let's get that out of our heads right now. Protecting your family is not a luxury reserved for the wealthy. For the vast majority of people, it is profoundly affordable. Now, before we get into the nuts and bolts of term versus whole life, which is where most guides start, we need to do something far more important. We need to reframe what life insurance actually is. We're conditioned to think of it as death insurance. It's a morbid topic. It's uncomfortable. But that's the wrong frame. Life insurance isn't for you. It's for them. It's for the people who depend on you. It's not about planning for your death. It's about providing for their life. It's a financial tool that says, if the unthinkable happens, the people I love most in this world will be okay. The mortgage will be paid. The kids will still go to college. My spouse won't have to face financial ruin on top of emotional devastation. Think of it this way. You have car insurance not because you plan on getting in a wreck, but to protect you from financial catastrophe if you do. You have homeowner's insurance, not because you expect your house to burn down, but to make you whole if it does. Life insurance is income insurance. It's mortgage insurance. It's a future protection tool. It is, in its purest form, an act of love and responsibility. When you see it that way, the entire conversation changes. It's no longer a morbid, scary document. It's a promise. It's a legacy. And our job here is to make sure that promise is rock solid. That it's written on paper, not on hope. To do that, we have to start at the beginning with the most fundamental choice you will ever make in this process. It's the fork in the road that determines everything else about your policy, your premiums, and your protection. I'm talking about the two titans of the life insurance world, term and permanent. This single decision is where most people get lost, and it's where they're most vulnerable to being sold something that doesn't fit. But there is one simple, powerful question you can ask yourself that will instantly illuminate which path is right for you. Cuts through all the sales pitches and all the noise. And that is exactly where we're going next. We're going to break down term life insurance, what it is, who it's for, and why it's often called the purest form of life insurance. Then we'll tackle its much more complex and often controversial sibling, permanent life insurance. We'll dissect the different kinds from whole life to universal to variable, and I'll show you the hidden fees and risks that are rarely discussed. After that, we'll dive into the fine print, the riders, the exclusions, the contestability period, all the so-called boring stuff that can make or break a claim. We'll walk through the application and medical exam process, so you know exactly what to expect. By the time we're done, every page of that policy will make perfect sense. You'll be in control. You'll be the expert on your own future. So let's start with the most fundamental question of all. Forget the jargon, the policy documents, the sales pitches. At its heart, what is life insurance? It's not just a contract, it's a promise. It's a financial tool designed to do one thing, and one thing only. To protect the people you love from financial hardship when you're no longer there to do it yourself. Think about it this way. Imagine a young couple. Let's call them Sarah and Tom. They just bought their first home. They've got a 30-year mortgage, a mountain of hopes and dreams, and a beautiful 2-year-old daughter named Lily. Their world revolves around building a future for her. Tom works in construction, a physically demanding job, and Sarah is a freelance graphic designer, building her business from the ground up. Their income combined just covers the mortgage, the car payments, the groceries, and saving a tiny bit for Lily's future. They are, like so many of us, walking a financial tightrope. One day, Tom is in a tragic accident at work. The unthinkable happens. In an instant, Sarah's world is shattered. She's not just dealing with the crushing grief of losing her partner, the love of her life. She's also facing an avalanche of financial terror. How will she pay the mortgage on just her fluctuating income? How can she afford childcare to even be able to work? What happens to their dream of sending Lily to college? The home they built together, the future they planned, is suddenly on the verge of disappearing. Now let's rewind that story. But this time, a year before the accident, Sarah and Tom sat down and bought a simple life insurance policy. It felt like just another bill at the time, another expense in a tight budget. They paid about $50 a month for a policy that would give Sarah a check for $500,000 if Tom passed away. They hoped they would never ever need it. But they did. In this version of the story, the grief is still there. It's still immense and overwhelming, but the financial terror is gone. That $500,000 check, the death benefit, arrives. It's tax-free. It's hers. With it, Sarah can pay off the mortgage completely. The house is theirs, free and clear. She can take 6 months off work to grieve with her daughter without worrying about a single bill. She can set aside a large portion for Lily's college education, ensuring that dream stays alive. The insurance didn't bring Tom back. Nothing can. But it acted as a financial fortress, protecting his family from the economic fallout of his death. It honored the promise he made to always take care of them. That, right there, is the power and the purpose of life insurance. It's a plan for the what if. To understand how this promise works, we need to know the cast of characters involved. There are 4 key players in every life insurance story. First, you have the insurer. This is the life insurance company. They are the ones making the promise. They're the big, regulated financial institution that manages the money and pays the claim when the time comes. Second, there's the policyholder or the policy owner. This is the person who buys the policy and is responsible for paying the bills, which are called premiums. In our story, Tom was the policyholder. He owned the contract. Third, you have the insured. This is the person whose life is covered by the policy. When the insured person passes away, the policy pays out. In most cases, the policyholder and the insured are the same person. Tom bought a policy on his own life, but they don't have to be. For example, a business owner might buy a policy on a key employee, or an adult child might buy a small policy on an aging parent to cover final expenses. The key rule is that the policyholder must have what's called an insurable interest in the insured person, meaning they would suffer a financial loss if that person were to pass away. You can't just take out a policy on your neighbor or your favorite celebrity. And fourth, and most importantly, is the beneficiary. This is the person, the people, or even the entity like a trust or a charity, who receives the money when the insured person dies. Sarah and Lily were Tom's beneficiaries. This is the whole reason the policy exists. Choosing your beneficiary is one of the most critical decisions you'll make, and it's vital to keep it updated as your life changes, after a marriage, a divorce, or the birth of a child. So the mechanics are simple. The policyholder pays small, regular premiums to the insurer. In exchange, the insurer promises to pay a large, lump sum death benefit to the beneficiary if the insured person passes away while the policy is active. Now, you might be wondering, how can a company take in $50 a month and promise to pay out $500,000? Sounds almost too good to be true. The magic behind it is a concept called risk pooling. Imagine a massive swimming pool. Thousands and thousands of people, all like Tom, are paying their $50 a month and pouring it into this pool. Most of those people will live long, healthy lives and pay into the pool for decades. Statistically, only a very small number of them will pass away unexpectedly in any given year. When a tragedy does occur, the company simply takes a bucket of money from that enormous, shared pool and gives it to the family who needs it. It's the law of large numbers at work. The risk is spread out across a huge group, making the promise secure and the cost affordable for each individual. Okay, so we understand the why, the who, and the how. Now we get to the biggest fork in the road, the fundamental choice you have to make when you buy life insurance. It's the difference between term and permanent. These are the two main categories, the two flavors of life insurance, and almost everything you'll ever see is a variation of one of these two. Let's start with term life insurance. The easiest way to think about term is to compare it to renting an apartment. You pay rent for a specific period of time, a 1-year lease for example, and during that time you have a place to live. When the lease is up, you can renew it or you can move out. The protection is gone. Term life insurance works the same way. You are buying coverage for a specific term, a set number of years. The most common terms are 10, 15, 20, or 30 years. You pay your premiums, and if you pass away during that term, your beneficiaries get the death benefit. If you outlive the term, say you buy a 20-year policy and you're still healthy on day 1 of year 21, the policy simply expires. It's over. You got the protection you paid for, and now it's done. There's no refund, no residual value. Just like you don't get your rent money back after your lease ends. Because of this simplicity, term insurance is pure protection. It does one job and one job only. And because of that, it is incredibly affordable, especially when you're young and healthy. A healthy 30-year-old might be able to get that $500,000 20-year policy for less than the cost of a few fancy coffees each month. This is why it's the right choice for the vast majority of people. It's designed to cover your biggest responsibilities during your most vulnerable years, the years you're raising kids, paying down a mortgage, and building your career. The goal is that by the time the 30-year term is up, the kids are grown and independent, the house is paid off, and you've built up enough savings and investments that you don't need a massive life insurance policy anymore. You've become self-insured. Now for the other side of the coin, permanent life insurance. Term is like renting, permanent is like buying a house. It's a commitment for your entire life. As long as you keep paying the premiums, the policy will be there. It doesn't expire after 20 or 30 years. It will pay out whether you pass away tomorrow or on your 105th birthday. But there's another huge difference. Unlike renting, when you buy a house, you're also building equity. Permanent life insurance has a similar feature. It includes a savings or investment component called cash value. A portion of your premium payment goes toward the cost of the insurance itself, and another portion goes into this cash value account, where it grows over time, tax deferred. You can borrow against this cash value or even surrender the policy to take the cash out if you need it. Because of this lifelong coverage and the cash value component, permanent insurance is significantly more expensive than term insurance. the premiums can be 5 to 15 times higher for the same amount of death benefit. There are several types of permanent insurance like whole life and universal life, each with its own rules for how premiums work and how the cash value grows. We will break those down in detail later in the series. For now, just understand the core concept. Term is temporary, affordable, pure protection. Permanent is for life, more expensive, and combines protection with a cash value savings element. So you have a choice. Do you rent your protection for the years you need it most, keeping your costs low and investing the difference yourself? Or do you buy your protection for life, paying more for a guarantee and a built-in savings vehicle? That decision is one of the most important financial choices you'll ever make, and it depends entirely on your unique story, your goals, and your financial philosophy. There is no single right answer, only the right answer for you. And figuring that out is exactly where we're going next. So you're standing at a crossroads. On one side of the road, you have a sign that says, simplicity and affordability. On the other, a sign that says permanence and equity. This is the fundamental choice in the world of life insurance, the great debate that has filled financial talk shows and internet forums for decades. We're talking about term versus permanent life insurance. Let's break this down, not with complicated jargon, but with an analogy everyone understands: housing. Think of term life insurance as renting an apartment. It's straightforward, it's cost-effective, and it serves a very specific purpose for a specific period of time. You sign a lease, let's say for 10, 20, or 30 years. During that lease, you pay your monthly rent, which is your premium. In return, you get a place to live, your death benefit protection. If something happens to you during that lease term, your family gets the full value of that protection tax-free. It's simple, it's powerful, and for the amount of coverage you get, it is by far the cheapest option. Let's imagine a couple, Mike and Jessica. They're in their early 30s, just bought their first house with a 30-year mortgage, and have a 2-year-old daughter. Their biggest financial fear? If one of them were to pass away unexpectedly, the other wouldn't be able to afford the mortgage and raise their child. Their need for protection is huge right now, but their budget is tight. For them, a 30-year term policy is a perfect fit. They can get $1 million policy for a surprisingly low monthly premium, maybe the cost of a few pizzas or a streaming service bundle. That policy is designed to last exactly as long as their biggest financial obligations, until the mortgage is paid off and their daughter is grown up and financially independent. It's pure, unadulterated protection. It does one job and it does it exceptionally well. But what's the catch? Just like renting, at the end of the lease it's over. Once that 30-year term is up, the protection vanishes. You're left with nothing to show for all those payments you made, just like you don't own a piece of the apartment you rented for years. If you want to continue coverage, you'll have to get a new policy at the rates for a 60-something-year-old, which will be astronomically higher, assuming you can even qualify medically. For Mike and Jessica, that's a trade-off they're willing to make. Their goal is to be self-insured by then, with their house paid off and a healthy nest egg built. The term policy is the safety net while they build that wealth. Now let's walk across the street to the other option, permanent life insurance. And the most classic form of this is called whole life. Term is like renting, whole life is like buying a house. It's a much bigger commitment. Your monthly payments, your premiums are significantly higher. But you're not just paying for a temporary roof over your head. You are building equity. This is the single biggest difference. A whole life policy is designed to last your entire life, as long as you pay the premiums. It never expires. And a portion of every single premium you pay does two things. One part pays for the cost of the insurance itself, and the other part goes into a special built-in savings account. This account is called your cash value. This cash value is a living benefit. It's your money. It grows over time at a guaranteed, fixed rate, and it grows tax-deferred. Think of it like a forced savings plan. It's a conservative, stable asset that you can access while you are still alive. You can take out a loan against it to pay for a down payment on a car, a child's college education, or to supplement your retirement income. You don't have to qualify for the loan because you're essentially borrowing from yourself. And if you pass away, your family still gets the death benefit, although any outstanding loans will typically be deducted from the final payout. So who is this for? It's for someone who wants guaranteed lifelong coverage. Maybe you want to ensure there's money to pay for estate taxes, so your heirs don't have to sell off assets. Maybe you have a special needs child who will require financial support for their entire life. Or maybe you just value the discipline. You see the forced savings component not as a bug, but as a feature. It's a way to guarantee you're building wealth without having to think about it or time the stock market. This brings us to the famous mantra you've probably heard 1,000 times. Buy term and invest the difference. The argument is simple and, on the surface, very compelling. Says, don't get that expensive whole life policy. Instead, buy the cheap term policy for your protection needs, and then take the money you save, the difference in premiums, and invest it yourself in the stock market in something like an S&P 500 index fund. The theory is that over 30 years, the returns you get from the market will far outpace the slow, steady growth of a whole life policy's cash value. By the time your term policy expires, you'll have a massive investment portfolio that will make the death benefit irrelevant. And mathematically, this can absolutely be true. If you are incredibly disciplined, if you automate your investments every single month without fail, if you never panic sell during a market crash, and if you don't raid that investment account to buy a new car or go on a fancy vacation, then yes, you will likely end up with more money. But that's a lot of ifs. And this is where the debate moves from a spreadsheet to human psychology. The reality is, most people are not that disciplined. Life gets in the way. A car breaks down, a medical bill pops up, and that invest the difference money is the first thing to get cut from the budget. The beauty of a whole life policy, its supporters argue, is that it removes the temptation. The premium is a bill you have to pay, and the savings component is baked right in. It's an automated system for people who know that their own worst enemy is their lack of discipline. It's not about getting the highest possible return. It's about getting a guaranteed, consistent return that you can't mess up. So let's put them side by side. Term life. The cost is low. The duration is temporary. The complexity is very simple. And it has zero cash value. Its sole purpose is a death benefit. Whole life. The cost is high. The duration is permanent for your whole life. The complexity is higher, with moving parts like cash value and dividends. And it has that built-in tax-deferred cash value that acts as a savings vehicle. Neither of these is inherently good or bad. They are two completely different financial tools designed for different people with different goals, budgets, and levels of financial discipline. One is a scalpel, designed for a precise, temporary job. The other is a multi-tool, designed to do several jobs over a lifetime, but at a higher cost and with less specialized efficiency. The question you have to ask yourself is not, which one is better? The right question is, which one is better for me? Am I a disciplined, do-it-yourself investor who just needs a temporary safety net? Or do I value guarantees, permanence, and a system that forces me to save for the long haul? But what if you feel like you're stuck in the middle? What if you like the lower costs associated with term, but you also want the permanence and the cash value growth of a whole life policy? What if you want a hybrid? A policy that tries to give you the best of both worlds? Well, the insurance industry heard that question, and it responded with a whole new generation of flexible modern policies. We're talking about universal life, variable universal life, and the one you see advertised everywhere today, indexed universal life. These policies introduce market-based returns and incredible flexibility, but they also bring a whole new level of complexity and risk that you absolutely must understand before you even think about signing on the dotted line. And breaking down that fascinating, and sometimes dangerous world of hybrid policies is exactly where we are headed next. So let's dive into that world. Imagine you walk into a hardware store. You need a screwdriver, a knife, and a can opener for a camping trip. The salesperson could sell you 3 separate high-quality tools, or they could sell you a Swiss Army knife. It's one single convenient package. It does everything you need, kind of. The screwdriver is a bit flimsy, the knife isn't as sharp as a dedicated blade, and the can opener is awkward. It works, but it's a compromise on every single function. That, in a nutshell, is a hybrid life insurance policy. These policies are one of the fastest-growing products in the insurance industry, and for a simple reason. They tap into 2 of our deepest financial fears at the same time. The first fear is dying too soon and leaving our families in a financial lurch. That's what traditional life insurance is for. The second fear, which is arguably even more terrifying for many Americans, is living too long. Not just living a long, healthy life, but living a long life that requires expensive, long-term care that could drain every penny you've ever saved, leaving nothing for your spouse or your kids. A hybrid policy, most commonly a life insurance policy combined with a long-term care, or LTC benefit, promises to solve both problems with one monthly premium. The sales pitch is incredibly seductive. It goes something like this. Listen, you can buy a traditional long-term care policy, pay thousands of dollars a year for decades, and if you're lucky enough to never need it, all that money is just gone. It's a use it or lose it gamble. But with our hybrid policy, you have a pool of money. If you need long-term care for a nursing home and in-home aid or assisted living, you can draw from that pool of money while you're still alive. And if you pass away without ever needing care, no problem. Your family gets the entire amount as a tax-free life insurance death benefit. You can't lose. On the surface, that sounds like a perfect solution. It removes the use it or lose it risk of standalone LTC insurance. And it's true, that is a major advantage. Let's say you buy a hybrid policy with a $500,000 death benefit. 20 years later, you have a stroke and need in-home care that costs $6,000 a month. With this policy, you can start pulling that $6,000 a month directly from your $500,000 benefit. You use it for 3 years, spending a total of $216,000 on your care. Then you pass away. Your family would receive the remaining $284,000. It's a system that provides flexibility. But like that Swiss Army knife, the convenience comes at a cost, and the devil is hiding in the details of that compromise. This is where we need to turn the shiny sales brochure over and read the fine print, because the dangers of these policies are very real. The first and most obvious one is the cost. An all-in-one solution is almost never the cheapest solution. These are typically built on a permanent life insurance chassis like whole life or universal life, which, as we've discussed, are already significantly more expensive than term life insurance. When you add the complex long-term care component on top, the premiums can become substantial. You might find that you could buy a 30-year term life policy for a massive death benefit and a separate, dedicated long-term care policy for the same price, or even less than one of these hybrids. And in that case, you get two specialized tools that are often better at their specific jobs. The second and far more insidious danger is complexity. These contracts are not simple. They are layered with jargon and specific triggers that dictate when and how you can actually access your money for long-term care. The salesperson might make it sound easy, but the policy document will have very precise definitions. For instance, to qualify for benefits, you typically have to be unable to perform 2 or 3 of the 6 activities of daily living, or ADLs. These are basic things like bathing, dressing, eating, continence, toileting, and transferring, meaning getting in and out of a bed or chair. A doctor has to certify that you can't do these things. But what if you can still technically feed yourself but you can't cook? Or you can get out of bed but you can't safely walk to the bathroom? You might be in a situation where you genuinely need help, but you don't technically meet the policy's rigid definition to trigger the benefits you've been paying for. Then there's the elimination period. This is like a deductible but for time. The policy might state there's a 90-day elimination period. That means after your doctor certifies you need care, you have to pay for the first 90 days of that care completely out of your own pocket before the insurance company pays a single dime. That could easily be $15,000 to $30,000 you have to come up with unexpectedly. The third major issue is inflation. This is the silent killer of all long-term financial plans. A hybrid policy might offer a long-term care benefit of, say, $5,000 a month. In 2026, that sounds pretty good. It would cover a significant portion of care costs. But this policy is designed to protect you in your 70s, 80s, or 90s. What will $5,000 a month be worth in 2056? With historical inflation rates for medical care, it might only cover a week in a nursing home. To combat this, you can purchase an inflation rider, which increases your benefit amount each year. But these riders are incredibly expensive, and they can dramatically increase your already high premium. Many people trying to keep costs down opt out of the inflation rider, and in doing so, they are essentially buying a policy that is guaranteed to be inadequate when they actually need it most. Finally, we have to talk about the opportunity cost. Let's go back to that idea of buying a simple, cheap term life insurance policy and investing the difference in premiums. A 40-year-old might pay $2,000 a year for a hybrid policy, or they could pay $300 a year for a robust term policy, and invest the remaining $1,700 every single year into a simple, low-cost S&P 500 index fund. After 30 years, assuming a conservative average market return, that investment account could easily grow to over $250,000. That's $250,000 in a liquid investment account that they control completely. They could use it to self-insure for long-term care. And if they never need it, that money is part of their estate, completely flexible for their heirs to use as they see fit. With the hybrid policy, your money is locked up with the insurance company, accessible only under their strict rules and conditions. So, after hearing all of this, are these hybrid policies a complete scam? No, not at all. But they are a niche product for a very specific person. A hybrid policy might be a good fit for someone who is in their 50s or 60s, has a high net worth they want to protect from being wiped out by healthcare costs, and who, for health reasons, may not qualify for a standalone long-term care policy. They are for the person who values the guarantee and the simplicity of an all-in-one package more than they value the most mathematically optimal financial return. They are buying peace of mind and are willing to pay a premium for it. For almost everyone else, especially younger people or those on a budget, the strategy of buy term and invest the difference is almost always going to be the more powerful and flexible path to wealth creation and financial security. You get the pure, cheap death benefit you need to protect your family, and you maintain control over your own investment dollars, allowing them to grow for whatever future you might face. The key takeaway is this: a hybrid policy isn't just a life insurance policy. It's a complex, long-term financial instrument that locks you in for decades. It's a decision that should be made with extreme caution and a full understanding of the alternatives. But what if you could take some of the best features of these advanced policies, like the ability to access money for a critical illness or long-term care, and add them to a much simpler, more affordable policy? Turns out you can. These powerful, a la carte upgrades are called riders, and they can completely transform a basic policy into a customized financial safety net. But just like anything else, choosing the wrong ones can be a catastrophic waste of money. And exploring the world of these riders, separating the must-haves from the useless upsells, is precisely what we're going to do next. Think of riders as the optional extras on a new car. Some, like airbags and anti-lock brakes, are non-negotiable lifesavers you'd be crazy to skip. Others, like custom spoilers or neon underglow, are just expensive fluff that do nothing to protect you on the road. The trick is knowing the difference. The insurance agent might present them all as equally important, but they are not. Your job is to build a custom-fit suit of armor for your family, not to buy every shiny gadget on the shelf. Let's start with the absolute must-haves. These are the riders that, for most people, provide such an incredible amount of value for their cost, which is often zero, that it's almost always a mistake not to have them. First up is the Accelerated Death Benefit Rider, sometimes called a Living Benefits Rider. And honestly, this one is a game changer. For decades, life insurance had one grim trigger: you had to die for it to pay out. But what if you were diagnosed with a terminal illness, say with 12 months left to live? You're facing catastrophic medical bills. You might want to stop working to spend time with family. Maybe you have a dream of seeing the Grand Canyon one last time. The financial stress in that final year can be suffocating. This rider allows you to access a significant portion, often 50 to 90%, of your death benefit while you are still alive. It transforms your policy from just a death benefit into a crucial financial tool for end-of-life care and dignity. Gives you control. Gives you options. It allows you to write the final chapter of your story on your own terms. The best part? Most modern policies include this rider for free. It's built into the cost. If a policy you're looking at doesn't have it, or tries to charge you extra for it, that's a massive red flag. Next is the Waiver of Premium Rider. This is your policy's own insurance policy. Imagine you're a 40-year-old carpenter. You pay your life insurance premiums every month without fail. Then one day you have a bad fall on the job site and become totally and permanently disabled. You can't work. Your income vanishes. The last thing you can afford is another monthly bill. Without this rider, you'd likely be forced to let your life insurance policy lapse, canceling the very protection your family needs now more than ever. But with the Waiver of Premium Rider, if you become disabled for a certain period, typically 6 months, the insurance company waives your premiums. They pay them for you. For as long as you remain disabled, even if it's for the next 25 years, your policy stays in full force. You pay nothing, but your family remains fully protected. This isn't a luxury. It's a critical failsafe that ensures your safety net doesn't disappear the moment you actually fall. The third one in this top tier, especially for young families, is the Child Term Rider. For a very low flat fee, maybe $5 or $10 a month, this single rider provides a modest term life insurance policy on all of your children. That includes any kids you have now and any you have in the future, with no new applications. The coverage amount is usually small, something like $10,000 or $20,000. And let's be clear, the purpose here isn't to replace income. It's to handle the unthinkable. In the unimaginable event of a child's passing, this rider provides immediate funds to cover funeral expenses, medical bills, and allows the parents the financial breathing room to grieve without worrying about how they'll pay for a headstone or take unpaid time off work. But here's the hidden superpower of this rider. When your child becomes an adult, they typically have the option to convert that rider into their own permanent life insurance policy, often up to 5 times the original amount, with no medical exam. You are essentially guaranteeing your child's future insurability, regardless of any health conditions they may develop later in life. It's one of the most powerful and selfless financial gifts you can give them. Now let's move into the category of riders you should strongly consider, depending on your situation. These aren't automatic yes, but for the right person they are incredibly powerful. The first is the guaranteed insurability rider. Think of this as the right to buy more insurance in the future no matter what happens to your health. Let's say you're 25, single and healthy. You buy a modest $250,000 policy because that's all you need and can afford. But you add the guaranteed insurability rider. Fast forward 10 years. You're now 35, married with 2 kids and a mortgage. You need more coverage, but you've also developed high blood pressure and sleep apnea. Trying to buy a new policy on the open market would be brutally expensive, if you could even get approved. But with that rider, you have the contractual right to purchase additional insurance at specific milestones, like age 30, 35, 40, or upon getting married or having a child, at the same standard health rating you had when you were 25. No questions asked. No medical exam. You locked in your good health. For anyone who's young and expects their financial responsibilities to grow over time, this rider is a phenomenal way to future-proof your protection. Another powerful one is the long-term care rider. The cost of long-term care in the United States is astronomical, with nursing homes easily costing over $100,000 a year. It can wipe out a lifetime of savings in a few short years. Standalone long-term care insurance is an option, but it's often prohibitively expensive. The LTC rider is a hybrid solution. It allows you to accelerate or take advances from your death benefit to pay for qualifying long-term care expenses, whether it's in a facility or at home. If you use it, the death benefit your heirs receive is reduced. If you never need long-term care, your family gets the full death benefit. It's a way to make your life insurance dollars do double duty, protecting your family from both your death and the potentially devastating costs of extended care in your old age. It's not as comprehensive as a standalone policy, but it's a far more accessible and affordable solution for millions of Americans. Finally, let's talk about the riders that are often pushed hard but are usually a bad deal. These are the expensive upsells, the spinning rims of the insurance world. At the top of this list is the Accidental Death and Dismemberment Rider, or AD&D. The pitch is seductive. For just a few dollars more, we'll double or even triple the payout if you die in an accident. It sounds fantastic. Who wouldn't want $2 million instead of one? But here's the catch. The definition of accident is incredibly narrow and restrictive. It has to be a very specific type of accident, and death must usually occur within 90 days as a direct result. It excludes death from illness, which is how the vast majority of people die. It often excludes things like surgical mishaps, drug overdoses, or acts of war. You are paying extra for a lottery ticket. The odds of dying in a way that qualifies for this rider are tiny. For the same money you'd spend on an AD&D rider, you would almost always be better off just increasing your base policy's death benefit. A larger base policy pays out for death from any cause: cancer, heart attack, falling pianos, you name it. Don't pay extra for coverage that only works in a handful of niche, statistically unlikely scenarios. The other one to be extremely wary of is the return of premium rider. Again, the sales pitch is powerful. If you outlive your 30-year term policy, we'll give you back every penny you ever paid in premiums. It's a can't-lose proposition. Sounds like free insurance, but it is one of the most expensive riders you can buy, often increasing your premium by 50, 100, or even 200%. You are massively overpaying for your insurance for decades. Let's do the math. A standard 30-year term policy might cost you $100 a month. With the return of premium rider, it might be $250 a month. That's an extra $150. Over 30 years, you'll pay an extra $54,000 to get your premiums back. But what if you had just bought the standard policy and invested that extra $150 every single month? In a simple index fund averaging an 8% return, after 30 years you would have over $200,000. The insurance company is counting on you not understanding the time value of money. They take your massive overpayments, invest them for 30 years for their own profit, and then give you just your original dollars back, completely eroded by inflation. It's a terrible financial deal. Choosing the right riders is about a thoughtful diagnosis of your life and your risks, not a blind accumulation of features. It's about building a policy that's as unique as your family. Now that you know how to customize your policy with the right riders, you're ready to face the next hurdle. The insurance company's deep dive into your life. It's called underwriting, and it's where they decide if you're a good risk or a bad one, and what they find can make or break your ability to get covered at all. We'll pull back the curtain on that entire process next. So, let's talk about that deep dive, that financial colonoscopy the insurance company performs. It's called underwriting, and it's the single most mysterious and frankly the most intimidating part of buying life insurance. But it doesn't have to be. Think of it less like an interrogation and more like a puzzle. You are the puzzle, and the underwriter is the detective trying to put all the pieces together to see the big picture. And that picture tells them one simple thing. How risky is it to insure your life? The entire goal of underwriting is to place you into a specific risk category. The lower your risk, the lower your premium. The higher your risk, the higher your premium. Or you might be denied coverage altogether. They're not trying to be mean, they're trying to be accurate. Their entire business model depends on accurately predicting risk across millions of people. So what clues are these detectives looking for? It all starts with the first piece of evidence, your application. This is your official testimony. It's dozens of questions about your health, your family's health history, your job, your hobbies, and your lifestyle. Do you smoke? Have you ever used illegal drugs? Do you have a history of heart disease, cancer, or diabetes? What about your parents or siblings? Did they have any of these conditions before age 60? Do you enjoy skydiving, scuba diving, or piloting private planes? Now, here's the most important piece of advice I can give you about this entire process. Do not lie. Not even a little white lie. It might be tempting to shave a few pounds off your weight, or conveniently forget that you smoke a cigar once a month, or that you tried marijuana back in college. You might think, how will they ever know? Oh, they will know. These companies have been doing this for over 100 years. They have systems and databases you've never even heard of. A lie on your application is called material misrepresentation. If you die within the first 2 years of the policy, a period called the contestability period, and they discover you lied about something significant, they can, and they absolutely will, deny the death claim. Your family gets nothing. All those premiums you paid? Gone. It's the worst possible outcome. So be ruthlessly honest. The truth might cost you a bit more in premiums, but a lie could cost your family everything. The next major piece of evidence is the paramedical exam. For most policies, especially those with larger death benefits, the insurance company will send a licensed medical professional, usually a nurse, to your home or office. It's free of charge, it's convenient, and it's a critical part of their investigation. They'll check your height, weight, and blood pressure. They'll also take a blood and a urine sample. This isn't just a basic checkup. They are running a very specific set of tests. Your blood will be screened for a whole host of things. They're looking at your cholesterol levels, your triglycerides, and your liver and kidney function. A key test is the A1C, which gives them a picture of your average blood sugar levels over the past few months, a powerful indicator for prediabetes or diabetes. Your urine sample is tested for cotinine, which reveals any nicotine use, whether from cigarettes, vapes, or patches. They also screen for a wide range of illegal and prescription drugs. So if you said on your application that you're a non-smoker, but the test finds nicotine, you've been caught. Your application will be re-rated as a smoker, and your premium will easily double or triple. The paramedical exam is their way of verifying the claims you made in your testimony. But their detective work doesn't stop there. They have access to a few secret weapons. One of the most powerful is something called the MIB, or the Medical Information Bureau. Think of the MIB as a credit bureau, but for your medical and insurance history. It's a non-profit organization owned by hundreds of member insurance companies in the US and Canada. When you apply for life, health, or disability insurance, you sign a release that allows the insurer to check your MIB file. So what's in this file? It doesn't contain your full medical records. Instead, it contains special codes that represent specific medical conditions or risk factors that you've disclosed on previous insurance applications. Let's say 5 years ago you applied for a policy and mentioned you had sleep apnea. A code for sleep apnea would be added to your MIB file. Now, when you apply for a new policy and you don't mention the sleep apnea, the new insurer pulls your MIB report, sees the code, and immediately knows you've omitted something. The MIB's sole purpose is to prevent fraud and keep people from hiding pre-existing conditions. It's a cross-checking system that ensures the information you provide is consistent over time. Next on the list is the prescription history check. Just like they can pull your MIB file, they can also pull a comprehensive report of every prescription medication you've been prescribed over the past 5 to 10 years. This is an incredibly revealing piece of the puzzle. You might not mention on your application that you've been treated for depression, but your prescription history will show a long-term prescription for an antidepressant. You might downplay your high blood pressure, but they'll see the prescriptions for lisinopril. This database tells them the drug, the dosage, the prescribing doctor, and the pharmacy where you filled it. It paints a very clear, very objective picture of your health, one that's impossible to argue with. It's another powerful tool to verify the information on your application. Finally, for many policies, they'll pull your motor vehicle report or MVR. You might wonder, what does my driving have to do with my life expectancy? A lot, actually. Your MVR is a window into your lifestyle and your attitude towards risk. If your record is clean, great. But if it's littered with speeding tickets, reckless driving convictions, or worse, a DUI, that's a massive red flag. To an underwriter, a DUI doesn't just mean you made one bad decision. It suggests a pattern of high-risk behavior. Statistically, people with DUIs have a higher mortality rate, and not just from car accidents. So, your driving habits become another data point in their overall risk calculation. Once the detective, the underwriter, has gathered all this evidence, the application, the medical exam results, the MIB report, the prescription history, and the MVR, they sit down to build their final profile of you. They weigh all the factors, both good and bad, and assign you to a risk class. This classification will directly determine the price you pay. The best possible class is usually called Preferred Plus or Preferred Elite. This is for the super healthy, the people who have ideal height and weight, excellent blood pressure and cholesterol, no nicotine use, a clean family history, a safe job, and no risky hobbies. These people get the absolute lowest prices. The next step down is Preferred. This is still for very healthy individuals, but maybe there's a minor issue. Perhaps your cholesterol is slightly elevated, or a parent had a health issue before age 60. You're still in great shape and you'll pay a very competitive rate, just a little more than Preferred Plus. Then you have Standard Plus and Standard. This is where the majority of people land. You might be a little overweight, have managed high blood pressure, or other common well-controlled health conditions. It's the average risk category for a healthy person. The premiums are still affordable, but noticeably higher than the preferred tiers. If you have more significant health issues like a history of cancer, a heart condition, or poorly controlled diabetes, you might fall into what's called a substandard or rated class. These are often designated by letters or numbers, like Table B or Table 2. Each step down the table means an additional 25% surcharge on top of the standard premium. So, a Table B or Table 2 rating would mean you're paying the standard price plus an extra 50%. This allows insurance companies to offer coverage to higher-risk individuals instead of just declining them outright. So, the underwriter takes all this incredibly personal information and boils it down to one of these labels: Preferred Plus, Preferred, Standard, or Rated. That label is then attached to a price, and that is the offer the insurance company makes to you. It's a cold, data-driven process, but it's the engine that makes the entire industry work. It's how they balance the risk and ensure they can pay out the claims for the families who need it. Now that they've put you in a box and slapped a price tag on you, the real question is, what kind of protection are you actually buying? Is it a simple temporary policy that's cheap and covers you for a set number of years? Or is it a complex, permanent policy that's with you for life and even builds cash value? We're about to break down the single biggest decision you'll have to make: choosing between term life and whole life insurance. And the right answer for you is probably not what you think. This is the heavyweight title fight of the insurance world. In one corner, you have the lean, mean, cost-effective champion of simplicity, term life insurance. And in the other corner, the enduring, wealth-building, lifelong contender, whole life insurance. This isn't just a choice between two products. It's a choice between two completely different financial philosophies. Let's start with the crowd favorite, term life. Think of term life insurance like renting an apartment. You pay a monthly premium, your rent, and in return you get a place to live, or in this case, a massive amount of financial protection for a specific period of time. That period is the term. Could be 10, 20, or even 30 years. If you pass away during that term, the insurance company pays out the full death benefit to your family tax-free. If the term ends and you're still alive and well, the policy simply expires. The lease is up. You walk away and the coverage ends. You don't get your premium payments back. Its beauty is its brutal simplicity. Term life has one job and one job only: to replace your income and pay off your debts if you die unexpectedly during your peak earning and debt years. It's not an investment. It's not a savings account. It is pure, unadulterated protection, and because of that, it is shockingly affordable. Let me introduce you to Mark. Mark is 32. He and his wife just had their first child, and they bought a house with a 30-year mortgage. Financially, they're stretched thin. They have daycare costs, a mortgage payment, car loans, the whole American dream starter pack. Mark's biggest fear is what would happen to his family if he were suddenly gone. How would his wife pay that mortgage? How would she afford to raise their child, let alone save for college? Mark needs a huge safety net, but he doesn't have a huge budget. He gets a quote for a 30-year, $1 million term life policy. The cost? About $60 a month. That's it. For the price of a weekly trip to a coffee shop, Mark has secured $1 million, tax-free promise to his family. This promise lasts for 30 years, long enough for his child to grow up and become independent, and long enough to pay off the vast majority of their mortgage. If Mark outlives the policy, he'll be 62. The house will be paid off, his kid will be on their own, and hopefully, he'll have a healthy retirement nest egg. Was that $60 a month for 30 years a waste? Absolutely not. It was the price he paid for 3 decades of profound peace of mind. He bought what his family needed most, time and security. That is the power of term life. Now let's step into the other corner and meet whole life insurance. If term life is like renting an apartment, whole life is like buying a house. Your monthly payments are much higher, but you're not just paying for a temporary roof over your head. You are building equity. You are building an asset that is designed to last your entire life. A whole life policy is a 2-part contract. Part 1 is the death benefit, just like term insurance. It's a promise that will pay out to your loved ones no matter when you die, whether it's tomorrow or 60 years from now. It never expires as long as you pay the premiums. That's the whole life guarantee. But here's the game changer. Part 2 is a built-in savings component called cash value. Every time you pay your premium, a portion of that money pays for the actual cost of the insurance, and the rest is funneled into your cash value account. This account grows at a guaranteed, modest interest rate, and it grows tax-deferred. It's like a secret, automated savings plan bundled with your insurance. Over decades, this cash value can grow into a substantial sum of money that you can access while you're still alive. You can take out loans against it, tax-free, to supplement your retirement income, pay for a child's wedding, or handle a medical emergency, all without surrendering your policy. Let's meet Sarah. Sarah is 45, a successful business owner. She's already maxing out her 401k and her Roth IRA. She's looking for another place to park her money that offers stability, tax advantages, and guarantees that the stock market can't provide. For Sarah, a whole life policy isn't just about the death benefit. It's a diversification tool. She sees the high premiums not as an expense, but as a disciplined way to build another financial asset, one that isn't correlated with the volatile stock market. She knows the returns will be lower than her S&P 500 index funds, but she's not buying it for high returns. She's buying it for the guarantees, the tax-free access to cash later in life, and the certainty that her heirs will receive a permanent death benefit to cover estate taxes or leave a legacy. So, you see the difference? Mark needed maximum protection for minimum cost during a specific window of time. Sarah wanted a lifelong financial tool that combined protection with forced, guaranteed savings. This brings us to the great debate, the argument you will hear from almost every financial guru on the planet. Buy term and invest the difference. The logic is powerful and, on paper, almost unbeatable. The argument goes like this: whole life is way too expensive, the insurance part is overpriced, and the investment returns on the cash value are mediocre. So, do what Mark did, buy an affordable term policy. Then, calculate the difference in premium between that cheap term policy and the expensive whole life policy you were considering. Let's say the difference is $400 a month. Now, take that $400 every single month and invest it yourself in a low-cost stock market index fund. Over 30 years, that $400 a month, earning a historical market average of 8 to 10%, will likely grow into a nest egg that absolutely dwarfs the cash value you would have built inside the whole life policy. When your term policy expires, you won't even need life insurance anymore, because you'll be self-insured with the massive investment portfolio you built. Mathematically, this strategy often wins. But here's the billion-dollar question that the spreadsheet doesn't answer. Will you actually do it? Will you have the unwavering robotic discipline to invest that $400 every single month for 30 straight years without fail? Through market crashes when you're terrified? Through job losses? Through unexpected expenses like a new roof or a broken-down car? Through lifestyle inflation when you get a raise and would rather buy a nicer car than invest? Human behavior is the enemy of the perfect financial plan. The core strength of whole life is its mandatory nature. The premium is a bill you have to pay. It forces you to save and invest when you otherwise might not. It automates discipline. For some people, that forced mechanism is the only thing that ensures they build long-term wealth. They are paying a premium for that discipline, and for them it's worth it. So, who is term life really for? It's for about 90% of the population. It's for young families, new homeowners, anyone with dependents and significant debt. It's for people who need the biggest possible safety net for the lowest possible cost to cover a specific period of financial vulnerability. It's for the disciplined investor who trusts themselves to invest the difference. And who is whole life for? It's a more specialized tool. It's for high-income earners who have already exhausted other tax-advantaged retirement accounts. It's for wealthy individuals focused on estate planning and creating generational wealth. It's for business owners setting up succession plans. And yes, it's for people who know they lack the discipline to invest consistently on their own and are willing to accept lower returns in exchange for the guarantees and the forced savings mechanism. The choice isn't about which product is better. It's about which product is better for you. It's a deeply personal decision based on your income, your debts, your goals, and most importantly, your own financial discipline. But what if you feel stuck in the middle? What if you like the affordability of term but want the permanence and cash value of whole life? What if you want the potential for better returns than whole life can offer? Well, the industry heard you, and they created a whole universe of hybrid policies that try to be the best of both worlds. But in doing so, they also introduced a dizzying level of complexity. We're talking about policies with names like Universal Life, Variable Life, and Indexed Universal Life. These aren't just simple choices anymore. They are complex financial instruments. And one of them, in particular, has become the most controversial and misunderstood insurance product on the market today. I'm talking about Indexed Universal Life, or IUL. If you've spent any time researching life insurance online, or if you've been approached by an agent who seems a little too excited, chances are you've heard the pitch. And the pitch is intoxicating. It sounds like the perfect financial product, a secret the wealthy have been using for decades that's now available to you. Imagine a product that lets you participate in the stock market's gains, but with a safety net that means you can never lose a single penny of your principal, even if the market crashes. Imagine that all the growth inside this account is completely tax-deferred, and when you want to access that money in retirement, you can take it out as tax-free loans. And of course, when you pass away, your family gets a massive income tax-free death benefit. It's an investment, a retirement plan, and an insurance policy all rolled into one beautiful tax-free package. It sounds too good to be true, doesn't it? Well, as the old saying goes, if it sounds too good to be true, it probably is. And with IUL, the devil isn't just in the details. He owns the whole factory. To understand the controversy, we have to pull back the curtain and see how these policies actually work, not how they're sold. First, the indexed part. The agent will tell you your cash value is linked to an index, usually the S&P 500. This is technically true, but it's dangerously misleading. You do not own any stocks. Your money isn't actually invested in the S&P 500. Instead, the insurance company takes your premium, uses a portion of it to cover the cost of the insurance and their fees, and then uses a tiny fraction of the remaining money to buy options on the S&P 500. This is what gives you the exposure to the market. Because they're using options, they can create a floor, which is the biggest selling point of an IUL. The floor is typically 0%. So if the S&P 500 drops 20% in a year, your cash value account is credited with 0% growth. You don't lose money. Zero is your hero, they'll say. And that part is great. But what they often mumble through or leave out entirely are the mechanisms that severely limit your upside potential. The first is the cap rate. The insurance company puts a ceiling on your potential earnings. A typical cap rate might be 9%. So, if the S&P 500 has a fantastic year and goes up 25%, you don't get 25%. You get 9%. The insurance company keeps the rest. In a modest year, if the market goes up 7%, you get 7%. That seems fair. But over decades, missing out on those huge bull market years has a devastating impact on your long-term compounding growth. It's like driving a Ferrari that has a governor on the engine, preventing you from ever going over 60 miles per hour. But it gets worse. Some policies have what's called a participation rate. This means you only get to participate in a certain percentage of the index's growth, up to the cap. For example, a policy might have an 80% participation rate and a 9% cap. If the market goes up 10%, you first apply the participation rate. 80% of 10% is 8%. Since 8% is below the 9% cap, that's what you get. If the market went up 30%, you'd calculate 80% of 30%, which is 24%. But because you have a 9% cap, you only get 9%. You're getting hit from both sides. And just to add another layer of complexity, some policies use a spread. Instead of a cap, they'll just subtract a certain percentage from the market's return. If the spread is 5% and the market returns 12%, you get 7%. These caps, participation rates, and spreads are not fixed. The insurance company can change them. And in a low-interest rate environment, guess which direction they tend to go? Down. Your potential for growth can be squeezed over time. Now you might be thinking, okay, limited upside in exchange for no downside. I can live with that. But we haven't even talked about the real danger yet. The part that has caused countless policies to implode, leaving families with nothing after paying in for 20 or 30 years. I'm talking about the costs. The costs inside an IUL are astronomical, and they are relentless. First, you have premium load charges. A chunk of every dollar you pay is taken right off the top. Then you have administrative fees and policy management fees. But the real monster, the ticking time bomb inside every IUL, is the cost of insurance, or COI. The COI is the pure cost for your death benefit. And here's the critical piece of information that is so often glossed over. The cost of insurance is not level. It increases every single year as you get older. When you're 35, it's cheap. When you're 45, it's more expensive. When you're 65, it starts getting seriously high. When you're 75 or 85, it can become catastrophically expensive. In the early years of the policy, the plan is for your cash value to grow fast enough to overcome these rising costs. The slick illustration the agent shows you will project beautiful, smooth upward-sloping lines based on a hypothetical 6% or 7% average return. It looks fantastic on paper. But that illustration is a fantasy. It's a non-guaranteed sales projection. Here's the nightmare scenario that plays out all too often. You buy an IUL in your 40s. For the first 10 to 15 years, everything looks okay. The market does reasonably well, your cash value is growing. But then you hit a few flat or down market years. Your account gets credited with 0%, but the internal costs, the administrative fees, and the ever-increasing cost of insurance are still being deducted. Your cash value starts to stagnate or even shrink. Now you're in your 60s or 70s. The cost of insurance is starting to skyrocket because of your age. The market returns you need just to break even, just to cover the internal costs, become massive. A year of 0% gain is no longer just a missed opportunity. It's a devastating blow, as the high costs eat away at your principal. The policy, which was sold as a golden goose, is now a ravenous parasite, devouring your cash value from the inside out. The insurance company will send you a notice, stating that to keep the policy from lapsing, you need to start paying significantly higher premiums. Premiums you, now likely retired, cannot afford. You're faced with an impossible choice. Either pour thousands of extra dollars into a failing policy, or walk away, surrendering the policy and losing everything you paid in over the decades. The tax-free retirement income you were promised? It never materializes. The death benefit for your family? It vanishes. The policy implodes and the insurance company keeps all the money. This isn't a rare occurrence. It is a known feature of the product design. So who on earth should ever buy an IUL? The answer is an extremely small, very specific slice of the population, the very wealthy. I'm talking about people who have already maxed out their 401ks, their Roth IRAs, their HSAs, and every other tax-advantaged account available to them. They have millions in other assets and are looking for a place to shelter even more money from taxes, primarily for estate planning purposes, and they have the cash flow to massively overfund the policy in the early years to get ahead of the cost curve. For 99% of Americans, an IUL is a terrible solution to a problem they can solve much more simply and cheaply. The promise of market-like returns without the risk is a mirage. When you factor in the caps and the colossal internal fees, the long-term returns of an IUL often struggle to keep pace with even a conservative bond portfolio, let alone the stock market itself. The old, boring advice still holds true for most of us. Buy affordable term life insurance to protect your family, and invest the difference in low-cost index funds in a Roth IRA or 401k. You'll have more transparency, lower costs, greater control, and almost certainly end up with far more wealth in the long run. Navigating these complex permanent policies is a minefield. The slick sales pitches and confusing illustrations can easily lead you down a path to financial regret. But let's say you've done your homework. You've decided against the IUL and you've found the right policy for you. Whether it's a simple term policy or a traditional whole life plan, the process isn't over. In fact, the most personal and invasive part is just about to begin. You have to apply. And that means facing the underwriters, the gatekeepers of the life insurance world who will dig into every aspect of your life to decide if you're worth the risk. They're not trying to be malicious. Their job is to build a complete, unvarnished mosaic of you. They are risk assessors, and the picture they're painting is of your mortality. To them, you are not a person, you are a probability. A collection of data points that will be fed into a complex algorithm to answer one single question. How likely are you to die while this policy is in force? And to answer that, they need to know everything. It all starts with the application. This isn't like filling out a form for a new credit card. This is a legal document. When you sign it, you are attesting under penalty of law that everything you've stated is true to the best of your knowledge. And the questions will feel deeply personal. They'll ask about your income and net worth to make sure the death benefit you're requesting makes sense. They'll ask about your parents and siblings, and if any of them died young from things like cancer or heart disease. They'll ask if you smoke, how much you drink, and if you've ever used illegal drugs. And here is the single most important piece of advice I can give you for this entire process. Do not lie. Not even a little white lie. Don't say you quit smoking 6 months ago if it was only 6 weeks. Don't forget to mention that skydiving trip you took last year, or the high blood pressure medication your doctor prescribed. This is called material misrepresentation, and it is the insurance company's ultimate get-out-of-jail-free card. If you die within the first 2 years of the policy, a period known as the contestability period, the insurance company will launch a full-scale investigation. If they find you lied about anything that would have affected their decision to insure you, or the rate they charged you, they can, and they absolutely will, deny the claim. Your family will get nothing but a refund of the premiums you paid. All that planning, all that money, all for nothing because you were embarrassed to admit you have a few extra drinks on the weekend. Be honest. Be relentlessly, brutally honest. Let the underwriter do their job with the real facts. Next up is the part most people dread, the medical exam. The good news is, it's usually not as bad as you think. It's not a full physical. An examiner, often a paramedic or a nurse, will come to your home or office at a time that's convenient for you. It's free of charge, paid for by the insurance company. They'll measure your height and weight, take your blood pressure, and ask you to provide a blood and urine sample. That's usually it. It might take about 30 minutes. Now you might see ads for no exam life insurance and it sounds tempting, right? Skip the needle, get approved fast. But there's no free lunch. No exam policies almost always cost more for the same amount of coverage. Why? Because the insurance company has less information about you. They have less data, so they are taking on more unknown risk. To compensate for that unknown risk, they charge you a higher premium. For a healthy person, taking the 30-minute medical exam could save you tens of thousands of dollars over the life of a policy. So what are they looking for in those blood and urine samples? It's a chemical fingerprint of your health and habits. The urine sample is primarily for detecting cotinine, which is a byproduct of nicotine. This is how they verify if you're a smoker or use other tobacco products. Even if you use vapes, patches, or chewing tobacco, it will show up. And the difference in price between a smoker and a non-smoker policy is gigantic. Often 3 to 5 times more expensive. Your blood sample gives them a much wider picture. They'll run a full panel checking your cholesterol levels, your triglycerides, and your liver and kidney function. They're looking for red flags, signs of undiagnosed diabetes, hepatitis, or heart disease. They're essentially getting a snapshot of your internal health, a look under the hood that tells them more than the application questions ever could. But the exam is just one piece of the puzzle. The real deep dive happens behind the scenes, in databases you've probably never even heard of. First, they will pull your file from the MIB, which stands for the Medical Information Bureau. Think of it like a credit bureau, but for your medical and life insurance history. It's a non-profit organization owned by hundreds of member insurance companies. When you apply for insurance, the company can check your MIB file to see information you've provided on previous applications. It doesn't contain your actual medical records, but it contains codes for conditions you've disclosed before. If you told one company you had sleep apnea 5 years ago, but you forget to mention it on your current application, the MIB file will raise a huge red flag for the underwriter. Its entire purpose is to prevent fraud and concealment. Next, they'll access your prescription history. Yes, they can do that. With your signature on the application, you give them permission to pull a comprehensive report of every prescription medication you've filled for the past 5 to 7 years. So if you claim to be in perfect health, but your pharmacy records show you've been refilling prescriptions for depression, high cholesterol, or a heart condition, they will know. This is often the most revealing part of the investigation for an underwriter. It's hard data that can't be misremembered or concealed. And their investigation doesn't stop at your health. They want to know about your lifestyle, specifically how much risk you take. So, they will pull your motor vehicle report or MVR. A recent DUI, a history of reckless driving, or a string of speeding tickets tells an underwriter that you might be a high-risk individual in other areas of your life too. Paints a picture of your judgment. In some cases, they may even run a simple credit check not to see your score, but to check for things like bankruptcy, which can be an indicator of high stress. They are building a 360-degree view of you. After the underwriter has gathered all this information, your application, your medical exam results, your MIB file, your prescription history, and your driving record, they put it all together. They weigh the positive factors against the negative ones and assign you to a risk class. This classification will directly determine how much you pay. The best possible class is usually called Preferred Plus or Super Preferred. This is for the super healthy. People with ideal height and weight, perfect blood work, and a clean family history. Then comes Preferred, for very healthy people who might just miss the top tier on 1 or 2 minor metrics. Below that is Standard Plus and Standard, which is where most people land. It means you're of average health for your age. If you have more significant health issues like well-managed diabetes or a history of cancer that's in remission, you might be placed in a substandard class, often called a table rating. This means you'll pay the standard rate plus an additional percentage, maybe 25, 50, or 100% more, depending on the severity of the condition. The entire underwriting process can take anywhere from 3 to 8 weeks. It's a period of anxious waiting. Finally, you'll get the decision. There are 3 possible outcomes. 1, you're approved as applied for at the rate you were quoted. Great. 2, you're approved but at a different rate class than you expected. Maybe your blood work came back a little off, and they offered you a standard policy instead of preferred. You'll have the option to accept the policy at the higher price or decline it. Or 3, your application is declined. This is rare, but it can happen for serious, unmanaged health conditions or a combination of many high-risk factors. Getting through underwriting is the single biggest hurdle in the entire life insurance journey. It's a process of surrendering your privacy for the sake of security. You lay your life bare on the table for a stranger to analyze, all in the hope of being granted a promise. A promise that if the worst should happen, the people you love will be protected. But getting approved and receiving that thick packet of paper in the mail isn't the finish line. In many ways, it's just the starting gun. Now you have to manage the most important financial safety net you may ever own, and understand the fine print that governs that solemn promise for decades to come. This brings us to one of the most overlooked, yet most critical phases of the entire process: the free look period. In most states, once that policy document arrives, a clock starts ticking. You typically have between 10 and 30 days to review every single word, every number, and every clause. This is not the time to file it away. This is your no-risk money-back guarantee. Treat it like you're the most ruthless auditor on the planet. Did they spell your name right? Is your date of birth correct? A single typo here can cause a nightmare for your family down the road. Does the policy number on the paper match the one in your online portal? Is the death benefit exactly what you agreed to? Are the premium payments the precise amount you were quoted? And most importantly, read the list of exclusions. Are there any surprises? If you find anything at all, that doesn't sit right, you can return the policy for a full refund of any premiums paid. No questions asked. This is your final chance to ensure the promise you bought is the promise that was delivered. Once that free look period is over, your number 1 job as a policy owner begins: managing your beneficiaries. This is not a set-it-and-forget-it task. Life happens. People are born, people pass away, relationships begin and end. Your beneficiary designations must evolve with your life. Let's say you named your spouse as your primary beneficiary. What happens if, tragically, you were both in an accident? This is where a contingent or secondary beneficiary is absolutely vital. This is the person or people who would receive the benefit if your primary beneficiary is unable to. Without a contingent beneficiary, that money could get tied up in your estate, going through the slow, public, and often costly probate process, delaying the funds for your loved ones when they need it most. And you need to be specific. Naming my children isn't enough. You should name each child by their full legal name and date of birth. What happens if you get divorced and remarry? If you don't update your beneficiary from your ex-spouse to your current spouse, guess who the insurance company is legally obligated to pay? Your ex. It happens more often than you can imagine, creating heartbreaking and completely avoidable legal battles for the people you intended to protect. So, make it a recurring event in your calendar. Every year on your birthday or on the policy anniversary, pull it out and ask one simple question. Is this still who I want to protect? A 5-minute check-in can prevent a decade of pain. Just as you get an annual checkup for your health, your policy needs a regular financial checkup. Life insurance is not a crockpot you can just set and forget for 30 years. At least every 2 to 3 years you need to review your coverage. Think about what's changed. Did you have another child? Did you buy a bigger house with a much larger mortgage? Did you get a significant promotion that increased your family's standard of living? The policy that was perfect for you as a newlywed with a small apartment might be dangerously inadequate for you as a parent of 3 with a 30-year mortgage and college tuitions on the horizon. Your need for life insurance is a moving target, and your coverage must adapt accordingly. For those with permanent policies like whole life or universal life, this review is even more critical. You need to look at the policy's performance. How is the cash value growing? Is it on track with the illustrations you were shown when you bought it? Are the dividends or interest credits meeting expectations? If not, it could impact the long-term health of your policy, potentially even requiring higher premiums down the road to keep it from lapsing. Don't just assume everything is fine. Request an in-force illustration from your insurer every few years to see a projection of your policy's future based on its current performance, not the rosy picture from day one. And while you're doing your review, check the basics. Is your contact information up to date? If you move, you need to tell the insurance company. If they can't find you, they can't send you premium notices or important updates. Is your payment method current? A lapsed policy caused by an expired credit card is a silent tragedy. These small administrative details are the bedrock of your policy's security. Now, where do you keep this document? This piece of paper that represents hundreds of thousands or even millions of dollars. The answer is not in a random file folder in the basement. The most expensive life insurance policy in the world is the one your family can't find. First, you need a physical copy in a secure, fireproof, and waterproof location in your home. Second, you should have a digital copy saved in a secure cloud service. But the most important step is communication. Your primary beneficiary, your contingent beneficiary, and perhaps the executor of your will should all know 3 things: which company issued the policy, what the policy number is, and where to find the physical or digital document. A secret life insurance policy is a worthless life insurance policy. But what happens if life throws a curveball? What if you lose your job or face a medical emergency and you can't make a payment? The first thing to know is, don't panic. Every policy has what's called a grace period, typically 30 or 31 days after your due date. During this time, your policy is still fully in force. If something were to happen to you during the grace period, your beneficiaries would still receive the full death benefit, minus the premium that was due. It's a built-in safety net. If you have a permanent policy with cash value, you may have even more options, like using that cash value to pay the premiums for a time through something called an automatic premium loan. The key is to be proactive. If you know you're going to have trouble, call the insurance company. They have entire departments dedicated to helping policyholders find solutions to keep their coverage. Letting a policy lapse should be the absolute last resort. So here we are, at the end of this journey. We've demystified the jargon, we've navigated the different types of policies, we've walked through the application process, and now we understand how to be responsible owners of this powerful promise. But through all the talk of medical exams and cash value and premium payments, it's easy to lose sight of what this is all really about. Life insurance is not about you. It's about them. It's about the people whose pictures are on your desk or on your phone's lock screen. It has nothing to do with death and everything to do with life. It's the ultimate contingency plan, the financial backstop that allows your family's life to continue with dignity and stability, even if yours cannot. It's the guarantee that the mortgage will still be paid. It's the peace of mind that your kids will still have the college education you dreamed for them. It's the gift that prevents a personal tragedy from becoming a financial catastrophe. Buying life insurance is one of the most selfless, forward-thinking, and profound acts of love you can ever undertake. It's a financial transaction that is, at its core, purely emotional. It's you today, looking into the uncertain future, and building a fortress of financial security around the people you love most. It's the final chapter you write in your financial story, ensuring that your legacy is one of provision and care, not one of chaos and debt. It allows you to live your life more fully right now, with a little less weight on your shoulders, knowing that you have fulfilled one of your most fundamental responsibilities. The true value isn't just in the check that gets delivered one day. It's in the peace of mind that blankets your family every single day until then. So have the conversation, understand your needs, take that first step, because ensuring your family's future is the greatest present you can ever give them.